What if I told you the retirement system you've been paying into your entire adult life was never actually built for you? What if the goal was never your financial independence, but their financial dependence on you? The truth is, the retirement system, it's not broken. It's working exactly as intended, to make everyone else rich while you hope that you don't run out of money by 73. Today, we're exposing what's really going on behind the scenes, the hidden costs, the misinformation, the players pretending to help, and we're going to show you what you need to watch out for before you actually get taken advantage of. You ever wonder why retirement feels like a rigged game? It's because it is. The modern retirement system didn't evolve naturally like some animals out in the woods. It was designed mostly by people who had no intention of living under the rules that they created for you. You were told to take control of your financial future, but what that actually meant was, here's a confusing savings plan we don't teach you how to use with a big menu of high-fee funds designed by salespeople. Good luck, see ya in 40 years. For example, the 401k wasn't some brilliant innovation to help the average worker build wealth. It was a corporate loophole cooked up in the late 70s so highly paid executives could defer taxes. But once companies realized they could dump pensions and transfer all of the retirement risk onto you, suddenly everyone's got a 401k. And everyone clapped because they sold it to us as freedom. You don't want guaranteed income for life anymore. You want to be in charge, right? Freedom to invest, freedom to choose, freedom to screw it up because nobody gave you the first clue what any of this means. Meanwhile, the old pension system, where employers took care of your retirement, didn't vanish because it stopped working. It vanished because it was expensive and letting you figure it out was way more profitable. Now, you're the portfolio manager of your own retirement fund, with no training, no support, and little margin for error. But don't worry, they'll still blame you when it all goes wrong. Let's look at how that blame gets baked into the system, starting with something your employer prefer you don't understand. When you try to invest in a workplace retirement plan, you're usually handed a menu of different funds to choose from. A list of 10 to 25 plus investment options your employer has pre-selected for you. And here's where it starts to feel criminal. For most, the majority of those options are actively managed funds with annual expense ratios ranging from 0.04% to as high as 2%. To the average person who isn't an investing nerd like me and a lot of you out there, that might not sound like much. But over time, as I'll show you in a minute, those fees quietly siphon off tens or even hundreds of thousands of dollars from your future. If you're lucky, you'll see a few low-cost index funds mixed in with expense ratios around 0.10% or less. But in some of the worst plans that I've reviewed, the entire lineup is stacked with overpriced funds. Even these so-called index funds are charging active managed prices of 0.40% and up. It's like shopping at a department store that secretly marked everything up 300% before putting it on sale. Here's why these what appear to be small fees are so damaging. If you invest $500 per month into low-cost index funds in your retirement plan that charges 0.05% and it grows at 7% annually over 30 years, you'd have about $600,000 after paying $5,700 in fees. But with just a 0.75% annual fund fee for an actively managed fund, you'd only have $526,000. That small 0.75% fee just cost you $79,000, which is 13% of your retirement wealth just gone. But it gets worse. These actively managed funds consistently underperform simple, low-cost index funds. So the fees on top of the investment growth loss are even worse than what I showed. According to S&P's latest SPIVA 2024 data, 79% of all US actively managed funds underperformed their benchmark index last year. And over a 10, 15, and 20-year period, 90 to 94% of high-fee, actively managed funds underperformed. So you're paying 8 times more for worse performance. This might make you question why employers even offer these sorts of investment options if they're so terrible. On screen, I'll list a few reasons as to why employers and plan administrators offer expensive actively managed funds to employees. What it boils down to is was a mix of structural issues, incentives, and sometimes questionable practices. This is even worse when your employer is smaller because they have less negotiating power. They're almost forced to let retirement plan administrators put high-fee funds in your plan. Even larger companies that should have more power still litter their 401ks with high-fee trash. Take, for instance, one of my previous employers, Goodyear, which is a large company with 68,000 employees. Mostly low-cost options in the 401k, but we've still got landmines here. Trash, trash, and trash. It's like they went dumpster diving for fund options. And look, they even charge their employees to buy the company's own stock. Nothing screams thanks for your service like giving your employees the privilege of investing at a marked up price. Almost as offensive as the 5-cent pin that they gave me for working there for 5 years. That thing went directly in the garbage can. This reminds me of something Fred Schwed wrote in his brilliant 1940 book, Where Are the Customer's Yachts? The title refers to a story about a visitor to New York who admired the yachts of the bankers and brokers. Naively, he asked, where are all the customers' yachts? Of course, none of the customers could afford yachts. Schwed pointed out that Wall Street is not in the business of making you money. It's in the business of generating transactions. This insight from 85 years ago is more relevant than ever today. Your 401k fund menu isn't designed to make you wealthy. It's designed to generate fees. This is what's referred to as systemic evil. When a structure or institution quietly encourages behavior that benefits insiders while harming outsiders. No one person is acting all evil while twirling a mustache in the background. But the rules of the game are rigged in such a way that good people in the system can do harmful things and not feel responsible. And the longer this goes unchallenged, the more normal it feels. And because most people have no idea what they're doing when it comes to investing inside their retirement accounts, a financial advisor or planner seems like a pretty reasonable person to help navigate all of this stuff. After all, they're supposed to guide you, right? Yes, and they do, but they also guide the transfer of your wealth to theirs for the low price of 1 to 2% of your money. 0.75% if you have $2 million or more because, the poor people with less than that need to pay the 1 to 2% premium. Don't be fooled by how small that 1% number looks. That 1% fee on a $500 per month investment growing at 7% per year over 30 years will cost you $108,000. That's 18% of your wealth gone. To put it into terms that are easier to quantify, based on a 4% withdrawal rate, that's $4,300 less per year you get to spend in retirement. And this isn't even including the expensive funds that they might stick you in on top of that. For an actively managed fund that charges 0.50%, add another $60,000 to that $108,000 fee you're already paying. And the real kicker, most financial advisors aren't even legally required to act in your best interest. They can push high-fee funds or overpriced products that pad their own pockets even if those options will leave you worse off, as long as they can claim it was suitable for you. And the bar for suitable is practically on the floor, like my girlfriend's standards when she decided to start dating me. And guess what? The industry fights against fiduciary standards that put rules in place to legally require advisors to act in your best interest. Why? Because the minute they're held to that standard, they start recommending low-cost index funds, and that cuts off their commission gravy train. On the other hand, certified financial planners are required to act as fiduciaries when giving financial advice. But don't let that fool you, because they can still put you in expensive funds if they can justify it. Oh, and continue charging those high 1 to 2% fees if you're too poor, or 0.75% if you have $2 million or more. Now, they won't call you poor out loud, and they'll defend themselves and say, oh, we don't think they're poor, Jarrad. But all you have to do is follow the freaking money and see how they're charging you to get an idea of what they really think about you. Fee-only advisors and planners do exist, and they are the kind you should be working with. They can do everything a commission-based planner or advisor can do. They charge a flat rate, maybe $150 to $300 an hour, and you pay them when you actually need help. The industry doesn't want you to know too much about them, or they'll attempt to muddy the waters when trying to explain how they're not as good as commission-based advisors. Because why pay a set fee so you pay for services as you need it, when they can bleed you dry for 1% or more per year for the rest of your life? That's like paying to have your lawn mowed year-round in the Midwest, even though your grass only grows for roughly half the year. It doesn't make any sense. Why would they charge you like they're working full-time in your money when they're barely lifting a finger most of the year? Imagine if your mechanic charged you based on a percent of your car's value, or the cleaning company based on a percent of the value of your home, or the barista based on a percent of your income, since that coffee is making you more productive at work. Sounds pretty insane, right? Somehow the financial industry has tried to normalize us paying them a percentage of our wealth to pay for their services. In no other areas of our lives do we accept these sorts of predatory percentage-based fees. But in finance, everyone just goes along with it like it's no big deal when there are more fair-priced options through flat-fee hourly advisors. Since I know there's going to be a small minority of bootlickers out there defending commission-based financial advisors, on screen we've got 4 studies, from government reports to academic research, showing these advisors often push high-fee products to boost their own payouts, not your returns. This is what psychologist Philip Zimbardo in the book The Lucifer Effect called moral disengagement. It's where people justify unethical behavior by saying, well, everyone else is doing, or that's just how this system works. He's explaining exactly what's happening here. Advisors charge high fees, recommend overpriced garbage, and don't even see it as wrong anymore, because the industry has normalized it. And for the handful of you out there ready to twist my words, let's make something very clear. I'm not saying all advisors or planners are evil. I'm saying if someone's charging you a percentage-based fee on your assets every single year, you better question who that fee is really helping. Fee-only planners can be extremely helpful, and I suggest everyone consider working with one at some point to, at the very least, get a second set of eyes on your plan to make sure everything looks good, or if you need some help with the behavioral side of things. Because as a reminder, they can do the exact same thing as a commission-based advisor and planner. After filming this video, I found a website called hellonectarine.com. I'll drop a link to the website down in the description below. What they do is they make it easier for you to connect with one of these hourly certified financial planners. As you can see right here, they can do pretty much anything you need. At this point, they have 22 advisors available, and it looks like they charge anywhere between $150 to $300 per hour. I have zero affiliation with this company. I haven't talked to anybody that works there. I just noticed this, and I want to make sure that you can see how easy it is to work with one of these hourly planners as opposed to one of these other ones that are going to charge you a commission. So check it out if you want. Not only are we investors out here catching strays from our 401k plans and the financial advice industry to prove how the retirement system is designed to fail you. The complete lack of financial education might be one of the most insidious parts of the whole system. You're expected to make complex investment decisions that will determine your entire financial future, but nobody teaches you how. Think about it. You need a license to drive a car, cut hair, or sell real estate. But you can graduate high school and college without learning the difference between a stock and a bond, an index fund and trash universal life insurance, and what compound interest is, or how much you need to save for retirement. You're telling me I'm required to take a foreign language class to graduate from college, but no personal finance class. I'm out here conjugating verbs in Spanish while my bank account's speaking fluent bankruptcy. I'm starting to think that this isn't an accident. An educated consumer is a dangerous consumer. If people understood how money actually worked, they'd realize low-cost index funds are the best investment. New cars are a ripoff. They don't need mortgages they can't afford, overpriced degrees, extended warranties, endless subscriptions, whole life insurance, credit card rewards that trick them into spending more, a financial advisor skimming 1% off the top while pretending they're doing them a favor, or understand how interest on debt actually works. The fact that there are people in their 30s, 40s, and 50s who have literally never heard the words Roth IRA shows how big of a failure the education system actually is when it comes to personal finance and investing. They have to rely on random YouTube algorithms to hopefully serve up a video about the topic for them to learn about one. And even then, they might not even click on the video unless it has an enticing, borderline clickbait title and thumbnail. The financial industry spends billions on marketing to make investing seem very complicated and scary. They want you to believe that you need their expertise. But the truth is, successful long-term investing is actually pretty darn simple. A lack of education doesn't just keep you uninformed, it turns you into the ideal target for exploitation. Zimbardo in The Lucifer Effect would say this is a softer form of dehumanization. If you don't understand the system, you're easier to manipulate. You're not totally in control anymore, so they treat you like a wallet with legs. Social Security is the one part of the retirement system that actually works. It has never missed a payment in over 80 years and could pay full benefits for the next 75 years with minor tweaks. But politicians, financial institutions, and uninformed people on the internet keep telling you it's going bankrupt and you cannot rely on it. Why? Because if you believe Social Security won't be there, you'll put more money into the private retirement system that enriches all of them. And it also allows politicians from both sides to play ping pong with your emotions to score easy points while you're stuck in the middle getting smacked around like a little ball. Here's what they don't want you to know. It's not going bankrupt to the point where it won't be able to pay out anything. If nothing is done, in 2035, it will still be able to pay out roughly 83% of scheduled benefits to us younger people. I'm not saying this is ideal because I was promised 100% of my money, so I would expect 100% of my money. But it's disingenuous to frame it in a way to make us younger folks think there will be nothing left. Politicians have been aware of the Social Security surplus decline for decades, but they refuse to do anything about it. Every year they continue to kick the can down the road, the solution becomes more extreme than it needs to be. This isn't a left or right problem. Both sides are equally guilty of being cowards. They'd rather use Social Security as a campaign talking point than actually fix it with simple adjustments. Kind of like how they all talk about healthcare reform, but then they do nothing to fix it. It's almost like they want it around to keep all of us arguing like a bunch of pieces on a chessboard. While politicians play games with your future, the financial industry benefits from the uncertainty by convincing you to put more money into their fee-generating products. Meanwhile, they're gradually raising the full retirement age from 65 to 67, effectively cutting benefits. And now they're pushing to raise it even higher. This is all a part of the same pattern, transferring risk and responsibility from institutions to individuals while making it even harder to actually succeed. One of Zimbardo's biggest takeaways from the Lucifer Effect was that systems create environments where no one feels individually responsible, yet collective harm multiplies. That's exactly what's happening here. Politicians dodge responsibility, employers blame plan providers, advisors blame market conditions, but somehow you're still the one working into your 70s. It's time we face the truth. After decades of greed-driven decisions by people in charge, the entire retirement system is compromised. It still works, of course, but there's some banana peels on the racetrack. The rules are not built to protect us. They're built to protect them and siphon money out of our pockets. And if you're still assuming that there are enough guardrails to keep everyday people like us from getting exploited, you're wrong. We can't afford to take anything at face value anymore. What looks like a system designed to help us is really a frankenfuck mess that's been twisted and rigged to serve everyone but us. You've got to question everything because blind trust is exactly what they're counting on. The solution to all of this starts with education, but not the kind that comes from a sales pitch wrapped in a free dinner seminar about annuities. I mean real education, the kind that helps you see through the noise, ignore the hype, and make clear-headed decisions that actually align with your goals. You don't need a PhD in finance or to binge read 401k legislation in your free time. You need just enough understanding to recognize bad advice when you hear it and to confidently stick with a plan that works. So here's what you can do. Keep it simple. Follow the advice of the Boglehead's Guide to Investing and other research-backed sources. Low-cost, broadly diversified index funds or their ETF equivalent are your best bet for long-term success. A total US stock fund and a total international stock fund is plenty for most people until they're closer to retirement. No need to innovate your way into underperformance. Don't fall for the idea that complicated equals better. As Carl Richards puts it in The Behavior Gap, simple is not easy, but it works. Fancy charts and slick taglines don't beat long-term discipline. Know the fees. You wouldn't sign up for a gym membership that charges you 1% of your net worth every year, so don't pay that to a financial advisor either. Stick to fee-only advisors if you need help. Ask about their fiduciary status, and ask how they get paid. If the answer feels a little slippery, then walk away. And if your 401k plan options suck, take the best of the worst and supplement with a Roth IRA or traditional IRA that gives you access to low-fee funds. If you want help campaigning for a better 401k plan at work, then I'll drop a link in the description to help you do that from the Bogleheads forum. Maximize what you can control. You can't control the market. You can't control what your employer puts on the fund menu, but you can control your savings rate, your spending, and your own behavior. The more of those levers you can pull, the less dependent you become on a broken system. Don't fall into the fear trap. They want you scared. Fearful people are easier to manipulate. So instead, lean into optimism, but the rational kind. You cannot trust the retirement system to save you, but you can trust yourself to learn, to act, and to adapt. Remember what Zimbardo said in the Lucifer effect. Systems shape behaviors, but once you see the system for what it is, you gain the power to step outside of it and act with intention. I found the sweet spot for how much you should save every year. If you want to learn about what I discovered, then you can watch this video to your left next. Hit that like button before you go. I'll see you in the next one, friends. Done.